You've heard of an R-Vee, but what about an LV? It stands for living vehicle. It's sustainable and it embraces the remote work lifestyle, so you can live comfortably anywhere you want.
The biggest R-Vee price shock in years is happening right now. Dealers are tossing $120,000 rigs onto their Black Friday lists, not because they want to, but because they're being forced to. A massive refund surge blindsided lenders, froze financing, and sent dozens of approved buyers running for the exits. Suddenly, dealers were stuck with expensive units, rising interest costs, and zero time to react. And once the first prices crashed, the entire market followed within hours. But here's where things get dangerous. This wave hasn't peaked yet. The price crash. The first signs appeared quietly. A $120,000 R-Vee suddenly listed for $29,000 on a regional dealer site. At first glance, it looked like a typo. Then another unit dropped to $27,000. And by the end of the next day, one hit the lot at $25,000 flat. No balloons, no banners, no sales pitch, just a number that should never exist on a rig built for six-figure buyers. Internal markdown sheets confirmed the reality. Dealers were moving faster than manufacturers expected. Units tagged as premium just months ago were now priced below the cost of their last parts shipment. The markdowns did not come from generosity. They came from panic. The moment these numbers hit the front page of dealer software, every other lot matched them within hours to avoid choking on their own inventory. The collapse erased the past year of equity for anyone who purchased at normal pricing. A $120,000 rig instantly valued at barely 1/5 of its sticker is not a discount. It is a reset of the entire pricing structure. And once that reset began, nothing slowed it. But the real trigger wasn't the markdown. It was the refunds that happened just before it, the refund trigger. 3 days before Black Friday, dealer tills started reversing instead of ringing. Financing partners sent cancellation notices at a pace that caught even veteran sales managers off guard. Buyers who had deposits down on high-end rigs simply backed out before taking delivery. A pulled-back loan here, a withdrawn application there, then dozens, then more. A redacted lender report showed the spike clearly. Withdrawals jumped within a single 24-hour block. What caused it? Not a protest, not a news story, just rising fear that taking delivery at full price was a losing bet with too many unknowns. When the refund count hit a threshold, dealers faced a simple math problem. Floor plan bills do not pause because customers panic. Every refunded contract meant a unit returning to the lot with a fresh balance due and no time to breathe. Once the refund wave peaked, lots had no choice except to liquidate. Dealers scrambled to offset the sudden cash gap by converting unsold inventory into immediate dollars. That meant cutting prices not by a little, but by enough to force movement within hours. And that is exactly what happened. But liquidation alone does not empty lots. What emptied them was the surge that hit once the numbers leaked. If these breakdowns are helping you stay ahead of this market, make sure you like the video and subscribe so you don't miss the next update. Tell me what pricing shifts you're seeing in your area, because real numbers help everyone stay informed. The rush. The moment those $25,000 listings surfaced, search traffic spiked. A time-stamped analytics snapshot showed a quadruple increase in interest for rigs, over 30 feet, within one evening. Auction platforms showed the same pattern. Bids appeared within minutes of each listing, and units closed faster than they could be relisted. The demand did not come from casual shoppers. It came from buyers who knew exactly what they were looking at. When a $120,000 R-Vee falls to the price of an older used towable, hesitation evaporates. People drove hours to grab rigs before someone else did. Lines formed at gates before opening. Dealers reported buyers filling out paperwork in the parking lot just to claim a unit before it even rolled out of the service bay. But buried inside that frenzy was a trap. A liquidation price does not erase long-term depreciation. Many who rushed in did not consider the next value drop, the repair backlog, or the resale math that follows a fire sale purchase. When a market moves this fast, the risk moves just as fast, only quieter. And the reason the risk grows is because prestige itself took a direct hit. Prestige collapse. High-end rigs rely on separation. Buyers pay for space, reputation, craftsmanship, and the feeling that their unit sits above the mainstream pack. But when a premium Class A appears at nearly the same price as a budget towable, that separation collapses instantly. A leaked listing screenshot showed it clearly. A once flagship $120,000 model, now sitting just a few $100s above an entry-level unit that would normally serve first-time first-time buyers. The moment this happened, brand hierarchy cracked. Prestige does not survive being parked beside something half its build cost and nearly equal its discount. Once potential buyers see a luxury model priced like a clearance special, the perception never fully recovers. That perception shift cascades through every future resale. Owners who bought earlier at full value now face a market that no longer respects the badge or the build tier. Their rigs lose resale strength, not because of condition, but because the brand lost its price identity. This shift also influences how dealers treat the line going forward. When a top-shelf unit does not command top-shelf numbers, the entire brand's long-term valuation becomes unstable. And with brand value shaken, the rest of the market begins to move in ways no one planned for. Overbuild, misfire. The trouble began long before the markdowns appeared. Factories placed production orders on the assumption that demand from the previous year would continue without interruption. Supplier records later showed that requests for components rose steadily through early spring, even as retail traffic quietly slowed. One shipment log captured a clear mismatch between how many unit suppliers were preparing for and how many dealers were actually moving. That document highlighted a gap that widened month after month, but the factories continued running at full output because altering quotas mid-cycle is expensive and disruptive. As a result, more units arrived at dealer lots than the market could reasonably absorb. These were not small batches. These were steady truckloads of new R-Vees reaching storage yards that were already close to capacity. A parts partner charted its own volume increase, showing orders climbing even as retail sales flattened. That chart became one of the first concrete pieces of evidence that production had overshot real-world demand. Excess inventory does not stay hidden for long. Once storage fills and turnover slows, the financial pressure begins building immediately. That pressure leads directly to markdowns because moving inventory becomes more important than holding margin. And once the extra units piled up, rising financing costs made everything worse. Financing squeeze. While excess inventory strained physical space, a second problem grew in the background. Dealers rely on floor plan financing to carry R-Vees until they sell, and the interest attached to those balances climbed sharply. A redacted finance memo confirmed that rates that once sat at 4% had climbed to 9% and sometimes higher, depending on the lender and the age of the unit. A cost that once felt manageable suddenly turned into a daily expense that refused to slow down. Dealers with rows of slow-moving R-Vees felt the burden first. Every day, a unit sat unsold added another charge, and when the numbers expanded across dozens of rigs, the cost became punishing. The memo included line items showing how quickly the accumulated interest overtook expected profit margins. When holding costs rise faster than revenue, liquidation becomes the only logical outcome. This financial squeeze explains why units already discounted from factory overproduction saw further markdowns. Dealers were no longer trying to maximize gains, they were trying to minimize losses before financing charges grew even heavier. That environment does not allow for patience or strategic pricing. It forces quick decisions. With interest devouring margins, another force stepped in to push dealers even harder, and that force came from the manufacturers themselves. Incentive push. As factory oversupply collided with rising financing costs, manufacturers introduced incentive programs designed to move aging inventory off lots. These programs were not openly advertised, but a redacted internal sheet outlined bonuses tied to clearing specific units within limited timeframes. Some incentives offered credits toward future orders, while others provided temporary financial relief on slow-moving R-Vees. The structure made it clear that clearing space mattered more than protecting pricing stability. Dealers facing pressure from floor plan interest often saw these incentives as the final push toward liquidation. The program sheet showed deadlines that required action within days, not weeks, which left little room for negotiation. When a dealer can offset some of their carrying costs by accepting a lower selling price, the decision becomes almost mathematical rather than strategic. The goal changes from earning profit to qualifying for relief. These incentives had a side effect. They created inconsistent pricing across different regions because not every dealer received the same terms. One location might drop a model substantially to capture a bonus, while another tried to hold pricing and missed the support. That imbalance further destabilized the market and eroded predictability, with incentives accelerating the pace of liquidation. A final factor amplified the inventory problem even further, and that factor arrived in the form of delayed parts. Parts pile up. Months earlier, suppliers delayed shipments of key components needed for new R-Vees, slowing production temporarily. But in an unexpected turn, those delayed parts finally arrived well after consumer demand had softened. A shipment record charted the late surge clearly, showing parts from 2023 reaching factory docks just as sales momentum dipped. Once those parts were on hand, manufacturers pushed them into finished units to avoid wasting materials already paid for. Those newly completed R-Vees then moved to dealer lots already affected by overproduction and rising interest expenses. Dealers suddenly faced a second wave of incoming inventory they had not planned for. The shipment chart visually captured the mismatch between delivery timing and real-world sales activity, displaying a spike in parts arrivals long after the retail slowdown had begun. This mismatch created logistical strain. Holding more units than expected meant renting additional storage, rearranging lot space, and absorbing even higher carrying costs. Dealers who already struggled with aging inventory now had even more rigs arriving at the worst possible time. Each incoming unit added financial pressure and increased the urgency to clear stock quickly, regardless of margin. With the bottleneck compounding every other issue, the panic phase became unavoidable, and that panic sets the stage for the next act, where the impact reaches ordinary owners: hidden costs. A liquidation price of $20,000 and $5,000 looks like a breakthrough, especially when the original sticker once sat at $120,000. But ownership costs do not fall at the same speed as retail pricing. Insurance still evaluates the R-Vee based on replacement cost, not liquidation value, which means coverage premiums can remain higher than expected. That difference becomes clear when comparing quotes across units purchased at normal pricing versus units acquired during a markdown window. Depreciation also behaves differently in a collapse. A curve plotted between the original $120,000 figure and the new liquidation number shows a steep vertical drop rather than a gradual decline. When the resale trajectory breaks that sharply, predicting the unit's future value becomes nearly impossible. Warranty gaps add a second layer of risk because many discounted rigs sit outside full coverage windows. Buyers often do not notice those gaps until repair needs arrive. Loan-to-value complications develop as well. If financing is used, the loan may reflect the discounted price, but the R-Vee's book value may not align with the lender's formulas. That misalignment can create negative equity far earlier than expected, and the financial risks grow sharper once service delays enter the picture. If you want the next round of price movements before they show up on dealer lots, make sure you subscribe now. The biggest changes usually hit quietly at first, and you'll want those updates the moment they surface. Service slowdown. The service environment has shifted in ways that directly affect ownership costs. Technician headcounts have fallen in several regions, and a local employment report from a town built around a major R-Vee facility confirmed reductions in overtime and contracted hours. With fewer technicians available, repair queues lengthen, and routine maintenance that once took days can now stretch into weeks. That slowdown increases the likelihood of deferred repairs, which often lead to higher costs later. Shops facing staffing shortages adjust their pricing structures accordingly. Labor rates rise to compensate for limited capacity, and owners absorbing those higher charges begin feeling the impact immediately. The same employment report showed a drop in total service staffing compared to the previous year, reinforcing the trend rather than suggesting a temporary shift. Longer repair delays strain owners who depend on steady maintenance. Minor issues escalate into costly failures. These slowdowns are not tied to lending or local economics, but result directly from reduced technician staffing. As repair queues grow and labor pricing increases, another problem emerges from the financial system itself, and that problem becomes evident once lenders and insurers rewrite their guidelines. Lender shift. The sudden drop from $120,000 to $20,000 and $5,000 forced lenders and insurers to adjust their risk models. Updated underwriting guidelines, shown in a redacted snippet, indicated stricter loan-to-value thresholds and tighter approval margins for recently discounted units. Lenders no longer want to issue loans that exceed the perceived stability of the asset, especially when the resale value has shown unusual volatility. For buyers using financing, these new new rules change the cost landscape. A lender may approve a loan only if the borrower contributes a larger upfront payment, which shifts more financial responsibility to the owner immediately. Insurance carriers adjust in parallel, often recalculating coverage limits or imposing additional conditions because the liquidation market suggests higher variability in replacement value. Financing a discounted R-Vee can leave the loan above book value within months, forcing owners to owe more than resale supports. This results from tightened underwriting, not depreciation or delays. As lenders tighten their formulas, the consequences ripple outward into communities tied to production. And those communities are now showing early signs of strain. Factory town shock. Townships built around R-Vee manufacturing are experiencing the effects of reduced output. Hiring pauses, overtime cuts, and lower supplier orders have begun appearing in employment data, and a local business activity index captured the decline clearly. Restaurants, transportation services, and small machine shops reported reduced demand once factory schedules shifted away from peak production levels. When the plants slow down, the surrounding economy follows. These communities depend on steady volume from manufacturers, and even small adjustments create measurable changes. Suppliers receiving fewer orders reduce their own staffing, and that reduction moves through the local economy one step at a time. The employment trend line from the affected region showed a gradual but persistent drop, suggesting the slowdown is not a brief interruption, but part of a longer adjustment. Lower factory output raises per unit costs, eventually pushing retail prices higher. Communities feeling today's slowdown may face deeper cuts if orders drop further, creating a long-term cycle that reshapes overall availability. With factory towns tightening and suppliers adjusting, the broader market pivot becomes clearer. And that pivot leads directly into the final act, where long-term consequences take shape. The coming drop. The used market has not fully reacted to the liquidation wave that pushed $120,000 rigs down to $20,000 and $5,000. Wholesale auction projections show another 20% decline waiting to work through the system, triggered by the backlog of trade-ins that dealers have not processed yet. A wholesale trend chart from the last quarter makes the pattern clear. The gap between retail asking prices and auction clearing prices has widened each month. Owners considering trade-ins may feel pressure to move quickly, but timing matters. Selling now locks in today's value before those projected declines hit the broader listing environment. Waiting increases the likelihood that trade-in numbers fall even further once dealers adjust their internal books to match the newest auction benchmarks. Holding long-term is an option only if the rig is already paid off and maintenance costs remain predictable. As those wholesale figures flow through dealer pricing models, the next price movement becomes unavoidable. And while used pricing prepares for another shift, manufacturers themselves are preparing for something larger: brand retreats. Production forecasting and analyst commentary suggest several smaller manufacturers will shrink their footprint over the next year. These companies entered the recent expansion cycle, expecting steady retail growth, but the sudden correction has exposed their limited resources. When production volume falls below a sustainable threshold, some brands begin reducing model lines, consolidating factories, or searching for merger partners to stay viable. The forecasting data shows declining output from firms with smaller dealer networks, and the trend appears consistent across multiple regions. As these companies pull back, the overall competitive field contracts. Fewer active brands mean fewer pricing pressures across the market, and that shift eventually affects what buyers see on lots. Reduced competition generally leads to firmer pricing and narrower discount windows, especially once inventory stabilizes. This reshuffling is separate from resale shifts and not tied to trade-ins. It stems from manufacturers tightening lineups during unstable demand, creating long-term changes in availability rather than short-term pricing movements. As brands reposition themselves, a different challenge emerges for anyone planning a purchase in the next few months. And that challenge centers on the timing window that controls buyer safety. Safe timing. The safest buying period across the next 60 days aligns closely with the end of dealer quarter cycles. 90-day price trend lines show a predictable pattern. Markdowns cluster near the final weeks of reporting periods when dealers push to reduce aging inventory. The recent drop from $120,000 to $20,000 and $5,000 created an unusual ripple, but the underlying timing rules still apply. Within the next 30 days, prices may soften again as dealers reconcile their books with updated auction values. The trend line illustrates this clearly, with a gentle downward slope beginning after the start of month reporting reset. Buyers waiting until the mid-cycle window gain two advantages. advantages. First, more units receive internal markdowns. Second, lenders update their loan-to-value guidelines once they have fresh data, reducing unexpected financing hurdles. By the 60-day mark, factory shipments force dealers to clear aging stock quickly. These decisions follow a predictable pricing pattern, creating a short, tactical window unrelated to consolidation or long-term market warnings. Once this window passes, the market shifts into a different phase entirely. And that phase reveals why Black Friday was only the beginning, the first warning shot. A 10-year pricing chart shows that the recent liquidation event aligns with broader structural cycles, rather than a one-off shock. Periods of steep discounting tend to precede several years of unpredictable pricing, driven by alternating surges in production, financing constraints, and material costs. The drop from $120,000 to $20,000 and $5,000 fits directly into that long-term pattern, signaling the start of an extended volatility phase. Past cycles reveal similar sequences. First, a sudden correction. Next, uneven inventory levels. Then, fluctuating retail pricing as manufacturers attempt to stabilize operations. This Black Friday marks the beginning of that sequence. As the chart illustrates, market volatility does not end after the initial drop. It expands as dealers, lenders, and suppliers react to each other's adjustments. The next seasons will bring sharper price swings as long-range R-Vee cycles compress. This shift is not about timing or brand strategy, but about understanding a reset that breaks from past patterns. The market is entering a new phase, and the next story begins now. If this breakdown helped you understand what's really happening behind these Black Friday R-Vee prices, make sure you hit that like button so more people see it. Drop a comment below and tell me what prices you're seeing in your area. Real numbers help everyone stay ahead of the next move. And if you want every update the moment it hits the market, subscribe and turn on notifications.